Welcome to today's Merk webinar. We will be going over our outlook for 2017. On today's call, we have Merk's President and Chief Investment Officer, Axel Merk. Joining alongside Axel will be VP of Quant Research and Trading, Daniel Lucas, Senior Financial Analyst, Nick Reese, and myself, Financial Analyst, David Song. At the end of today's presentation, we will have a Q&A. As always, we do encourage questions from the audience, so please feel free to ask a question at any point during the presentation by typing it into the questions box on your screen. Please also note that this presentation will be recorded. And before we begin, as an announcement, we will be having a quarterly webinar on January 19th. So mark that down on your calendars, and we will also follow up with reminder emails. And with that, I will now turn the call over to Axel to begin the presentation. Axel, the floor is now yours.
Thank you, David, and welcome everybody. Today we have near record attendance. Usually we only get this higher turnout when we focus on gold, and while we will talk about gold, quite likely even extensively, it is very nice to see, and I thank everybody for joining us for an Outlook webinar. Let's start with a review, and we're not going to talk too much about the past. I want to point out a couple of tidbits here. We had the Brexit vote this summer. Our office was staffed 24 hours that night to make sure that the risks that come with the currency markets are managed, and I thank my team for having done that fabulously. We then were humble enough to not take anything for granted for our US elections here. And clearly the markets have been very, very active since. If you look at that picture, that a variant of which you might have seen in the news of the various political leaders, only two of them will be in power in a few weeks. That's Madame Merkel of Germany in the middle, and on the left, the Japanese Prime Minister. On the very right, by the way, you've got the Italian Prime Minister. We did have in the lower right-hand side, you see an Italian flag that referring to the referendum we just had in Italy. I'd like to point out that had we had the referendum pass, the odds of having a populist government, not just part of the government, but maybe even lead the government, if not soon, at some point down the road, would have been rather high. Whereas now we pretty much are inheriting the status quo, which means a political mess in Italy, which is how it's always been. I say that. We've had over 60 governments in Italy since World War II, and we may well get another one. And so Italy is going to do what it's always going to do, and will try to address its challenges in its own particular fashion. And then, not to be forgotten, we got Madame Yellen, who hasn't raised interest rates all year. Now, clearly, in a good week or so, she is generally expected to hike rates. That will have been a 0.25% rate hike within 12 months. That's not exactly a lot. We'll talk quite extensively about inflation, and we believe that the Fed may firmly be behind inflation as inflation picks up, even if they raise more times next year. And more on that in a bit. So let's look at the markets, how they have been performing year to date. And very few people at the beginning of the year would have suggested that oil is the best performing asset for the year, or is going to be, at least as of right now. Gold has done well, but is off its highs, and many people have questions about gold, so that's one of the reasons we'll talk about extensively. It's now being surpassed by the S&P 500 year to date, at least when dividends are also considered that you get by investing in the S&P. And then the dollar hasn't gone up all that much, although it's been in the news obviously quite extensively. The bond market, and one doesn't see that here on this chart very well, we'll talk about bonds here. Gold market has had a sharp sell-off of late. Indeed, it's had the biggest sell-off it has had in decades, and so it's something that's worth looking at. And so as we ponder whether the markets might be nearing a top, we show you this let's say quirky chart, this chart that looks a little different. I'll pass it on to Nick to explain, and then I might chime in on that. Nick?
Thanks, Axel. So here we have a chart which measures the breadth of the S&P 500. And the breadth is a sort of technical indicator that describes the level of participation among member companies of a given index, and this is for the S&P 500, which, as you all know, has 500 large cap companies based in the US. And this chart goes back to the middle of, or the beginning of 1995, and shows the breadth among these three different bull markets. And the indicator that's being used here is basically one of the common breadth measures, which is the percent of stocks that are above their respective 200-day moving averages, averaged with the percent of member companies above their 50-day moving averages. Two popular metrics just averaged together to create a single data point. And data points are only given for days where the index is making a new all-time high, given that the framework for thinking about this this technical analysis is to see when a market's making new all-time highs, but there's declining or diminishing breadth or diminishing participation. That is sometimes a sign that that the bull market is aging and losing its strength. So you can see that it typically declines over time as the bull market ages. Certainly saw that in the peak in early 2000, that the breadth had really weakened quite substantially. Right now, it's at the weakest end of the current bull market, in the basically in the kind of high 60s range. So it's not a definitive indicator, but it's one additional data point to keep in mind as you think about the broad market direction here.
Thank you, Nick. The only thing I might want to add is on the right-hand side, you see this little wider gap. That wasn't a bear market. We just had an extended period where the market didn't make a new peak, but it didn't quite go into bear market territory, which is generally defined as a market coming down 20% from its top. And at the same time, now that we had made new highs, the breadth is rather weak, and that's just a symptom that maybe we are towards the end of this bull market. Now let's move on here to the so-called FANG stocks. Those are the darling technology stocks, and we're not making investment recommendation on them here. But the reason we show them is that in the late phases of a bull market, usually some darlings have developed. In the good old days, those used to be the so-called Nifty 50. In the late 90s, there were some tech stocks as well, and now these tech stocks here are in focus. And the one thing I like to caution is that sometimes when some of the favorite stocks turn, people say, oh, it's company specific. And just as the price of oil coming down, oh, this was specific to the oil sector. Well, more often than not, I would allege this can be the beginning of a wider trend where then other stocks are pulled down as well. But of course, it might happen that these darlings decline more than others, which often happens because obviously they have reached much higher valuations during the bull market. Now, two things here to watch out for that might work against these stocks. One of them is a trade under a Trump administration. If indeed Mr. Trump tweets in a way that upsets the Chinese sufficiently or institutes policies that upsets the Chinese leadership, these companies and are high-profile targets, most notably Apple, that might well be the target of any retaliation. And aside from the fact that from a populist point of view, Silicon Valley is almost like the new banking sector. It was first the bad bankers, and now it's the high-tech companies that are stealing our jobs. And so that's kind of one threat to these companies. The other one is one more based on the likely policies of Trump, and we'll talk about the agencies here in a minute. But one of the things that Trump wants to do is he wants to substantially lower regulations. And this is one thing actually where you don't necessarily need Congress to come along, because you can simply signal that you're going to enforce regulations much less. And if you do that, think about what regulation means. Regulations are really a barrier to entry indicator. If you have a lot of regulations and if you're a large company, you can deal with them. And so when you have a lot of regulations, such as we've had increasingly in recent years, the bigger companies tend to do well because they can deal with it, where small businesses suffering. So conversely now, when you cut regulation, well, that tends to favor small business. And if you just look at the performance since the election, the Russell 2000 has substantially outperformed the NASDAQ. The NASDAQ is, of course, where these companies are member of, and they are the large multinational tech companies, whereas the Russell 2000 tends to have more the domestic, smaller tech companies. And I am not giving here a prediction that the Russell 2000 necessarily will outperform the NASDAQ, but I think the odds of that happening are there to the extent that the outperformance isn't already priced in. And so with that here, let me pass it back here to Nick to discuss oil in the context of inflation. Nick?
Right, thanks, Axel. So this is a chart showing the year-over-year change in the oil price, which is the light blue line. That's WTI spot price, which is the benchmark oil price for the U.S. And in black is the monthly reading of the headline CPI year-over-year change. What you can see is that there's a relationship between the two. They track each other fairly closely. And the oil price decline that started in the middle of 2014 is now just finally being worked off in terms of the year-over-year rate of change 2.5 years later. And one thing that we know is that just given the current oil price around $50 a barrel, if the price stays roughly where it is as we get into early next year, when the back end of that year-over-year comparison is going to be at the lows, which were hit in January or February of last year, that year-over-year oil price change will be very close to 100%, and we might well get a headline CPI reading that's well above the 2% mandated Fed inflation target, which could change the market and Fed psychology around inflation. And just to give some additional numbers that aren't on the chart here, the headline PCE, which is what the Fed uses as their official inflation metric for purposes of meeting their mandate, is currently at 1.4%. The last time it was above 2% was back in early 2012, and that's when the unemployment rate was above 8%. So, as many of you may know, the Fed has a dual mandate of price stability, which is defined as headline PCE running around 2%, and also a dual mandate, or a second pillar of that mandate, which is that they seek to have an economy that runs at maximum employment. So currently the unemployment rate is at 4.6%. That's quite a bit lower than it was back when inflation was last above 2%, which was an unemployment rate above 8%. Just to put that into perspective, at the peak of the last economic expansion in terms of the unemployment rate, that was in October of 2006 at 4.4%. So we're very, very close to that at 4.6% currently. Given that, I think there's going to be potentially a big change as we get into early next year around the psychology of inflationary pressure in the economy.
Thank you, Nick. The reason why we show this is because it is tremendously important going forward, I believe, whether the sell-off in bonds that we have seen is a reflection of higher inflation expectations or on expectations of higher real interest rates. And when you have higher real interest rates, that tends to be good for the dollar in the long run, tends to be not so good for gold, as we will see here in a moment. Whereas when you have higher inflation, gold can do just fine in that environment. Indeed, historically, we in our analysis has done quite well as well. When you talk about currencies in general, many currencies tend to appreciate when inflation readings come out higher than expected. And that sounds counterintuitive, but the reason that happens is because there is a general perception that the central bank, and the Fed in the case of the US, will do the right thing and then hike rates. It's then in the aftermath where the dust settles, meaning the market assesses whether the central bank is behind the curve or has actually done, quote unquote, the right thing, whether that currency will continue to be strong or then weaken again thereafter. And so let's look here at these inflation expectations. They have been trending down for quite an extended period, and of late they have been trending significantly higher. Now, these inflation expectations that we show here are so-called forward inflation expectations that are supposed to take out things like short-term fluctuations in the price of oil. They never entirely do, and because of QE and related expansive monetary policies around the world, some central bankers are nowadays saying that these market-based indications aren't maybe all that accurate. Now, that said, clearly they show here an uptick, an upward trend in inflation expectations, that indeed inflation will pick up. And we'll talk about here inflation from a couple of different angles in a couple of minutes, but just keep that on the back of your head, that inflation may well be moving higher here and how that will potentially influence the markets going forward. So let me pass it here to Dan. And before I do that, let me just give a brief introduction to this, and Dan is going to reiterate some of what I say. But what we have done is we have run some regressions in assessing what has happened or what might happen if indeed the bond market continues to fall further. Now keep in mind that this is based on regressions over the past year. So this is really how the market has behaved in the last year. If the market continues to behave in the same manner, the sort of things we'll discuss on the coming slides may happen. I would like to caution, and I'll caution a few times here in the next couple of slides, that correlations are unstable and that this is not necessarily how things are going to unfold. But with that disclaimer out of the way, Dan, why don't you take us through the slides?
Thanks, Axel. So the basic idea of this analysis is we wanted to look at different asset classes and securities and groups and indices within those asset classes and see what could be a potential impact of rising yields in the US. So here we map out the potential impact of a 1% increase in US Treasury yields, and by 1% is meant a 100-point increase, so meaning from currently 2.4 to 3.4%. And basically what we do, we regress the sensitivity of US Treasury yields to these different proxies for the securities or indices that we chose using 1 year of data. And looking here at the worst performers to the best performers, we only included the top 5 and bottom 5 of our analysis. We see here that defensive stocks, S&P utilities, consumer staples, telecom services are the ones that could be affected to the downside the most by rising yields. And if you paid attention to the stock market in November, you can already notice that those were sectors that seen some outflows or seen some rotation out of the defensive stocks into financials and energy, which you can happen to find here as the best performers. So here we see financials and energy, high beta sectors, and obviously financials. The business model is directly related to interest rates, but also potentially benefiting could be industrials and materials, and financials, industrials, materials also are the sectors that were outperforming the most last month, and obviously factors in to our analysis here as well.
Let me just briefly chime in here. And so financials, of course, those tend to be banks, for example, and banks benefit when longer-term rates are higher. They benefit from the yield differential, with the differential between short-term and long-term rates. But this chart also shows that you do have to take these with a grain of salt. And so, for example, energy, keep in mind that energy stocks have been very depressed at the beginning of this year. And so there is not necessarily a causation here. This might just be the correlation rather than causation, meaning that the drop in bonds, the rise in yields, might be coincidental here. And so there's no assurance, definitely no assurance, that S&P Energy is going to continue to outperform the way it has. And so this is a way of understanding what has happened, and it does provide, of course, some sort of guidance because, for example, financials, we happen to agree that financials might perform quite well going forward. But this is just the first step to analyze what do I have in my portfolio, why has it behaved in a certain way, and then if you continue to believe that something in your portfolio is a valuable diversifier, well, that doesn't mean you necessarily have to chunk it. So please, not everybody sell everything that they have and only pile into what have been the top performers now of late. Back to you, Dan.
Then looking at fixed income, it's the most obvious with the mathematical relationship that yields go up, bond prices come down. So for the purpose of looking at this, I left out the most direct, obvious relationship, the U.S. government bonds, focused here on bond aggregates and sectors or parts of the corporate bond market. So again here, probably most impacted to the downside could be investment grade bonds of utilities and consumer staples sector, also communications, again, defensive sectors. On the upside, or least affected by this could be corporate bonds and financials, as well as mortgage-backed securities. And again, these are industries or securities are directly related to yields. In here, we also looked at bond aggregates. So one of the better performers here is the emerging market US bond aggregate. These are sovereign, quasi-sovereigns, and corporate EM issuers that issue bonds in US dollars, as well as pan-European bond aggregates, investment grade and high yield, and all the indices or securities that are looked at in fixed income, pan-European high yield bond aggregates were the only ones who statistically show a positive relationship with US Treasury yields.
Here again, keep in mind that this is past correlation. And so, for example, emerging market bonds, high yield bonds, those are the sort of bonds that tend to correlate well in a risk-on environment when the markets feel happy, so to speak. And so if you think there's going to be more turmoil in the market, those correlations might well be changing. So again, this is just a kind of a snapshot of what has happened, and doesn't mean that that necessarily will happen. But as part of kind of looking at all the markets, we think it's necessary to kind of look at the fixed income space as well. And of course, it does make sense that utilities might be underperforming.
Lastly, we want to look at FX and commodities. Again, not surprisingly here, since we based this analysis on historic data, the safe havens have performed and theoretically would perform most poorly in a rising yield environment. So we have gold, Japanese yen, and Swiss franc as the safe havens, as well as the New Zealand dollar, which could be related to it being a carry trade currency, and with rising yields in the US, which funds the carry trade, there can be a reversal in the New Zealand dollar. And on the upside here, we see commodities again, natural gas, crude oil, as well as the US dollar represented by DXY index. If you're interested in the composition, we have that in the back of the presentation for you.
Thank you, Dan. You may now be wondering if indeed yields move higher, will gold plunge, will crude oil go through the roof, and will the dollar strengthen? Well, as I indicated now quite a few times, this is if the moves of late are going to continue, if correlations remain stable, and we'll dive into correlations here, specifically with regard to gold in a moment. But ultimately, I believe, with regard to gold anyway, that a great deal depends on whether yields are rising because real interest rates are moving higher or because inflation is going to move higher. And so we're going to look at that as well in a moment. And right now, the market is pricing in that real interest rates might be moving higher. And that just give you a little bit of background here, also why the dollar might be up in the context, even if inflation were maybe to move higher. Historically, what we have seen is that when inflation ticks up in any one country, that the first reaction is that a currency strengthens. Now, that might not make any sense intuitively, but the reason that happens is because when inflation moves higher, the general perception appears to be that the respective central bank is going to do the quote-unquote right thing and tighten monetary policy. It's then only over time that the market is having another look. Well, did the Fed or central bank in other countries, did they actually do the right thing and get ahead of the curve and make sure that inflation didn't materialize, didn't get any stronger? And that's often when you see currencies weaken again. And so it's in this context that we have to look at this and saying, all right, in the immediate plunge of yields, people think, oh my God, yep, world is changing, the Fed is going to be all tight and so forth. And that's why the price of gold is dropping. The real question is what's going to happen in the medium term. Is the Fed going to stay behind the curve or not? And so with that said, let's move here through a couple more slides. This slide here shows the total debt outstanding throughout the world that is yielding negatively. And I happen to believe that the multi-decade bull market in bonds is over, and this summer we saw the peak in the bond market, peak in bond prices, meaning translates to negative yields at the extreme anyway in some of these countries. German debt, Japanese debt, for example, was yielding negatively. The U.S. Treasuries did not yield negatively at least not at the long end of the yield curve at any time. But you also see here marked on the right-hand side of the chart that bonds plunged. The amount of outstanding debt plunged by 11%. The bonds themselves didn't plunge by 11%. They plunged. Some bonds plunged by 5% or so. And so this is the prices plunged. That means the yields were going higher. There was less negative yielding debt outstanding, and I do believe that's going to be a bigger theme. That overall there's going to be a continued back of yield, and the question is, what does that mean for the markets? And so with that, let's move here a little bit towards politics. And I show here a page on regulatory policy, mostly because even if you don't Congress to move along, and we'll just sideline that for a moment here, a president has substantial power in the respective agencies because they can choose not to enforce certain laws, or, especially in recent years, a lot of governing was done through executive order and by imposing policies. Those are very easy to undo. I mean, not very easy. There's a big bureaucracy behind it, but still, you can change a variety of things. And if you just look at the environment, for example, I'd be very surprised if President-elect Trump is not going to approve at least one coal-powered power plant so he can tell his constituents that he brought those blue-collar jobs back. Let me make a broader point, though, here on regulatory policy before I dive here into one or two items in more detail. Regulatory burdens and regulatory policies are really a barrier to entry question when we look at investments. So when you are in a highly regulated environment, which in recent years had increasingly been the case, it increases the barrier to entry. To us, that means large companies have it easier because large companies are able to deal with the increase in regulation. So a lot of regulation is manageable for large business. It is a major headwind for small business. Obviously, large business also complains, but relatively speaking, large business can deal with regulations better than small business. And so now what happens when you have an administration come in that is likely to cut regulation, and even if you don't know the specifics of it, well, odds are that small business might be outperforming large business. And while we're not giving certainly not giving tax advice, while we're not giving investment advice here, if you look at the technology sector specifically, it is not surprising to us that the Russell 2000, for example, has outperformed the NASDAQ. The NASDAQ being the large multinationals, and the Russell 2000 more domestically focused, smaller companies. So the large cap, again, it tends to include the companies that obviously also deal internationally. There's more trade risk involved. But aside from that, the mere fact that regulations are likely to be cut or less enforced, that should favor the smaller cap companies. We wouldn't be surprised at all if that trend is going to continue. And then specifically alluded to trade, that's in the realm of Treasury. Clearly, we do not know exactly what the policy will be at this stage. Mr. Trump has bragged about saving jobs here and there. That's not a policy yet. That's mostly lip service to something. He has started a trade war already with China. And the question is how much real damage can be done there. Taiwan and China have this odd relationships where China does consider Taiwan to be part of China. And that is a red line that for internal politics in China cannot be crossed. And when you have a president that doesn't respect such lines, it is potentially possible that there will be retaliation against some comments or statements. And we can think of major tech companies that want to operate in China being kind of the target of that. Those are high-profile targets that are possible. The other item, though, on China specifically, there's been talk about labeling China a currency manipulator. That is mostly a label. The main thing it actually does, it moves power from the Treasury to Congress, because Congress then has a mandate to investigate what sort of manipulation it is, whereas without that label, Treasury is pretty much free to act. And so it gives Congress more power when that label comes. So that's one of the key reasons why previous presidents haven't gone down that road, because it's really not helpful to the president to do it. That said, it's an easy election promise to keep, and so it may well happen. The practical impact of that is bruising the ego of China, and that in itself, of course, can have repercussions. But we'll have to see whether they'll take that in strides. Let's move on here to trade policy, to tax policy. I'm sorry. A lot has been said about the Trump tax proposal. As you see here from the subtitle on the page, it says, watch the GOP tax proposal, specifically the Republican, the House GOP tax proposal. And the reason I say that is I happen to believe that Donald Trump's tax proposal was done on the back of an envelope and is lacking substance, whereas the Paul Ryan proposal, the one from the House, is similar in some ways, but has been vetted and has very substantive policies that could have major implications for investments. I don't happen to think that wiggling with the tax brackets, having more or fewer tax brackets is going to make huge a difference. But let me just mention a few things that the Ryan proposal has. And by the way, any tax proposal is starting in the House. And so this one may well be the starting point of any discussion. The Ryan tax proposal allows the full expensing of any new investments the first year. That's a sea change that would be a dollar positive, because it starts to move the U.S. economy from a consumption economy to one that encourages investments. Then the Ryan proposal says there's absolutely no taxation of foreign of the profits that we have hoarded abroad, except for a one-time tax, and it depends on whether it's cash or something else. It's under 10%. But the important thing here to watch is whether such changes are permanent. Anything temporary is not going to change the strategies too much. But really, if you want to attract capital into the U.S., you shouldn't be taxing the capital. That said, they would do a one-time tax of everything that's abroad at this stage, and regardless of whether to take it home or not. An important one is the giving up the deductibility of interest expense. So on a net basis, if you have interest income and interest expenses, net interest expense under the Ryan plan would no longer be deductible. That would make the economy less stable, because it makes debt a less interesting instrument to use. It promotes equity over debt as a use to finance operations. That said, it would be harmful to highly levered institutions, potentially anyway, because they might have an incentive to delever, potentially hurting their earnings power. Overall, let me get to the second but last point here. A very controversial point, and who knows whether that's going to be implemented, is that U.S. companies would no longer be able to expense any expenses they have abroad. And so if Apple, for example, has expenses in assembling its iPhones abroad, they couldn't deduct those expenses for tax purposes when they declare their U.S. taxes. And they really do that because they want to favor things that originate in the U.S. Ultimately, you see that in the last bullet point here, it changes the U.S. tax system from one that's taxing you based on your global income to taxing you on what you do in the U.S. And it brings the U.S. in line with the rest of the world. Now, what much of the rest of the world has is a value-added tax system. And that sort of achieves that as well because it taxes everything that's coming inbound. It slaps a VAT on it. The Ryan plan, it's disputable whether it complies with WTO rules, the World Trade Organization rules. The U.S. might get sued under those. Trump may not care. But the biggest outcry might be by companies. I keep mentioning Apple here. I don't want to single them out. I'm not giving investment recommendation. But companies like Apple would say you can't do that. So this is something that's very interesting to watch. Overall, though, these are policies that foster really the domestic sector, the domestic economy, and we'll have to see how much of that is going to be implemented. Now, one of the topics that does come up, of course, is that, well, shouldn't there be a huge boost to the U.S. dollar if indeed money is going to be repatriated? First of all, just because you give up the taxation doesn't mean it's going to be all repatriated. It does mean that the money is going to be allocated where it's going to be most efficiently used. Rather than politicians deciding where money is invested, the free market should allocate where it's invested. And of course, if the money is welcome in the U.S., that would, of course, be a positive. Now, that said, let me spend here a couple of minutes on the dollar as the reserve currency, and that might be odd as a topic, just in the backdrop where the dollar has risen quite a bit. Why would anybody think about the status of the dollar as a reserve currency? Well, there are good reasons. If you look at the foreign treasury holdings, they may have peaked. They have been. You don't see much of a downturn here. If you were to just zoom in on Chinese treasury holdings, foreign reserve holdings in particular, they have come down quite a bit. I allege that this is due to substantial structural changes that are happening, that have been underway for some time, that really have nothing to do with the election. And they have a lot to do with the changes in money market fund rules, notably institutional money market fund rules. Now, you may think this is an arcane topic, but it is such an important topic that I do believe it warrants a little bit of attention. And as I move here to the next slide on discussing the what you see is the funding cost. Well, what does any of this have to do with the dollar? What does it have to do with what we're talking about here, the outlook for 2017? Well, to take a step back, historically, money market funds are considered safe. They're considered to be cash equivalent. Well, they're not cash. They are money market funds. They invest in risky securities when they don't invest in U.S. government bonds, at least by regulation. They're not risky. And so the rules that have come into place make it less attractive to buy anything other than government bonds. And as a result, anybody who is not the government, and that includes municipal issuers, that includes U.S. corporates, but it includes also foreign banks and foreign corporates, they have a higher cost of funding. And what you see on this chart is that you see the 3-month LIBOR rate in blue, which shows that funding costs have been rising. It is relative to that's the LIBOR rate, that's the cost, that's the borrowing cost for banks who do not have access to the Federal Reserve. And then in comparison, you see the 3-month T-bill rate here as a comparison. You see that gap has been rising. The shaded line here is that rising line. And these money market fund rules, by the way, were phased in in the middle of October, but they were a long time in the coming. And so basically what it means that if you're a foreign issuer, you now have a higher funding cost. What does that mean? It means that in today's world, you no longer have this advantage of borrowing in the US if you are a foreign borrower. And that means that, and these rules, by the way, were in place since the 70s. And so this is really something that many people don't realize that this is, and it coincided in some ways with the Bretton Woods collapse. But what has happened is that one of the reasons people issued debt in the US is because there was this implicit guarantee in money market funds, which made it cheaper to borrow if you're on the borrowing side. Now that borrowing cost is increasing, I expect more funding to take place locally. So what does that mean for the dollar, and how does it relate to treasuries and US borrowing costs? Well, they are all related, because if you are an emerging market corporate borrower that historically borrowed money in US dollars, you would then sell the dollars to buy your emerging market currency, and then the government of that country tends to sell their own currency to buy dollars and then buy treasuries in order for that currency not to appreciate too much. And it is that sterilization that is less in demand now. And that is, in my view, a key driver why foreign treasury holdings are coming down. And there's just less of a need of that sort of sterilization. Now, the flip side of that is that when foreign governments buy fewer US treasuries, US borrowing costs might be rising. And that's where we come back to this exorbitant privilege. The exorbitant privilege, when you look up the definition, simply states that while the U.S. issues most of its debt domestically, and so that of course gives it a big advantage, and that it's the international reserve currency. Well, that reserve currency status is being jeopardized because in many ways, many people think that it's just institutional. The U.S. has the reserve currency status. I say not so fast. It's been because of a quirk in money market fund rules, which is one of the key drivers that that status has eroded. And by the way, that means that the U.S. is going to be yet another currency. And by the way, have you noticed that U.S. corporate borrowers have started issuing debt in euros? In many ways, the euro is trying to attract a lot of that capital where debt is being issued, and I allege that the euro has become a so-called funding currency, and so you see that people borrowing euros. That means in good times, when the market is in a quote-unquote good mood, when risk is on, the euro often has weakened, and then when risk is off, the euro has strengthened. The euro in many ways is becoming much more like the Japanese yen. Just back to the topic here of exorbitant privilege. Historically, the U.S. has worked like a bank in some ways. You borrow cheaply by issuing debt in the U.S., and then you invest in higher yielding assets, meaning you invest abroad and you gain a higher return. And some of that advantage is fizzling away, and that is something I think people should watch very, very carefully. Now, we talked about the dollar, we touched on China already. Let's move here to the chart on China and talk a little bit of what's happened in China. China, over the last 18 months, has turned backwards on many, many things, has become far more restrictive. There was a time when we were very positive on China, but China has become very restrictive. Most recently, they tightened capital controls for outbound investments. Indeed, the Financial Times just recently published that European companies have difficulty repatriating their money back to Europe, taking money out of China. Now, that's not a good omen for inward investments, because you're not going to invest money in the country if you can't take your money out. And part of that is, of course, because there has been pressure on the currency, with the Chinese trying to take money abroad. We see here the renminbi in the red line. The scale is inverted, meaning the red line moving downward reflects a weakening currency. And the Chinese in their defense had said that, we switched from trying to tie our currency to the dollar to tying it to a basket of currencies. Well, the index for that reference basket is the blue line, and as you can see, they've also underperformed that basket. The Chinese have no interest at this stage tying their currency to the dollar, because if they do that, they import U.S. monetary policy, which means that they would get a tightening and they're desperate for growth. They could get growth if they open up their country and if they allowed more domestic spending and entrepreneurship, but they have been using the old-fashioned tools to try to grow their economy, and that hasn't exactly worked, and that's one of the reasons why there's pressure on the currency. What we do expect is that as speculators are piling in on the short side, the Chinese do what they're known for. They will induce volatility. So once in a while you'll see a spike in the currency and there's going to be a big short squeeze. Well, at the same time, that may well be a very nice opportunity to short the currency further. Let's move here to the yen. One of the big changes that has happened in the world of late, and we've touched on that now a few times, has been this big sell-off in bonds. Well, when you have bonds sell off, your yields are rising, and especially if you look at the long end of the yield curve, the 10-year bonds were plunging, and we were moving from negative yields to positive yields in some countries, and including Japan, where the yields were backing up. Well, the Bank of Japan has come out and said, we're going to keep the long-term yields near zero. And what's happening then, of course, is then you have the yield differential rise between the yen and the dollar. And the yen historically has been quite sensitive to those yield differentials. And so as the yields are backing up in the US and they're kept on the floor, in Japan, the yen has weakened, and we expect it to potentially weaken, maybe even substantially further. Let's move to the euro. Mr. Draghi held a press conference in the morning, and he always has a little new twist on old ideas. Basically, he's initiating tapering while then arguing for an hour why what he does is not tapering. Basically, he indicated that rather than buying 80 billion euros a month in securities, he would buy 60 billion euros a month, which by my definition is tapering. And he would do it, though, until December, so he extends the purchase program rather than just a little bit. Now, I don't think anybody in their right mind would have, December next year that is, anybody in their right mind would have thought they would stop immediately with these purchases. The trend here is the important thing, and so, yes, this is tapering. Initially, the euro rallied. The euro then fell during the press conference for another reason, and that is that when the ECB buys these securities, they've been scrambling to find the right securities because there aren't so many left because they've been buying so many. And so they have removed the ceiling for the price or the lower boundary for the yield which they can buy, which used to be the deposit rate at the ECB. And without getting too technical, it means that some short-term rates are falling further. And that is the reason why the euro fell in the immediate aftermath. Now, the other thing, though, it does is it steepens the yield curve. The shorter-term rates are lower, the the longer-term rates are higher, and that is more stimulative to growth. Now, the Japanese reacted to that by putting the foot down and saying, nope, we don't allow the long-term rates to rise. At this stage, I don't think Draghi is going to pursue with the same policy, most notably because in September he said that the so-called fragmentation in the Eurozone is pretty much done. The markets are functioning quite well, which means there's really no need for the long-term yields to be squished to the bottom. If that's indeed the case, I would think that the euro can do quite well in that environment because of the tapering, because I do think we may have seen the low in the rates and that this might be the bottom and things might be moving upward. And then at the flip side of that, I happen to think that in the US, we're going to be firmly behind the curve as far as inflation is concerned, as we're not going to move fast enough. Now, with that said, let's move over to gold here. You can enjoy this cartoon here for a second, but let me dive right into it. And for those of you who've read a recent newsletter of ours, may have seen some of these charts here. This chart here shows the rolling correlation of the price of gold versus treasuries. And of late, the correlation to bonds has been very, very high. The correlation to treasuries has been very high. And you see that also in that table that Dan presented earlier, explaining why the price of gold fell so much, because bond yields were backing up and the price of gold was very sensitive to that. Well, if you look in the long run, that correlation is not stable. Now, when you run a regression like we did over the past year, and you look at the right-hand side of that chart, well, it was stable over that last year or so, year plus. And so keep in mind that this is not going to last forever. Now, the question really is, how does one think the dynamics are going to move out? And in the long run, yes, the correlation is zero. In the short term, the correlations to anything can be elevated. If we just zoom in here for a second on the Fed funds rate, let's move here to the next slide, and then maybe let me pass it on here to Nick to explain this slide here. Nick?
Right, so here we have the gold price going back to the beginning of 2015 in blue, and the Fed funds rate in red. And what it shows is that we've only had the one rate hike actually in this cycle. That was last December. As you may remember, all of last year there was this anticipation about an upcoming Fed rate hike. It seemed like it was going to happen over the summer, continued to get delayed. Eventually it did. The Fed did hike rates in December, and it's been a somewhat similar story this year, with coming into the year following that last December rate hike. The Fed was looking for 4 hikes this year. The market was more priced for about 2. Over the summer it looked very likely, or in the late spring it looked very likely that the Fed would hike rates in the summer. Then with Brexit and other factors, that again continued to get pushed back. It certainly does look like they will hike next week. The market's pricing basically 100% chance of that. But what I want to point out is that the gold price behavior ahead of this Fed hike does look somewhat similar to last year. And in my opinion, last year was a representation of the concept of buy the rumor and sell the news with respect to the dollar around the Fed rate hike, or looking at it the other way around, sell the rumor. Sell gold on the rumor of the Fed rate hike and buy on the fact, or the reality of it. And we may see something similar play out this year, although it will depend on the communication coming out of the Fed at the press conference next week, as well as their updated forecasts for inflation and growth and dot plot potentially.
Thank you, Nick. What's different maybe is that the Fed might be more emboldened to signal more rate hikes going forward. Now, that said, Janet Yellen has been burned so many times now in promising too many rate hikes that she might just say, hey, we're very data dependent, and yes, everything is good and well, but we don't know what policies are going to be. We have to wait till the law passes, and then we have to see how the market reacts and all that fun stuff. And so if I assess her correctly, she is going to be rather timid. Now, that said, of course, her term is coming to an end at the end of next year, and maybe some people suggest she's going to be more liberated to move, but she doesn't want to preside over a crumbling market, I don't think. So we'll have to see. Now, let's move here to the next chart here and show the gold versus the S&P 500. And again, this is a rolling correlation. Of late, the correlation has been quite negative. Over time, as you can see, the correlation does vary, and so one of the things that we have to keep in mind that in the long run, the correlation of gold to the S&P is near zero. Correlation is obviously a metric on how prices are moving together. And this is all relevant for the next chart, and you may have seen this before. We might have shown this to you. In every bear market we've had since the early 70s, with the notable exception of the early 80s bear market in the S&P, price of gold went up. Now, the big difference is that in the early 80s, real interest rates were driven very, very high by Paul Volcker, the then Fed chair. And so anybody who believes that Janet Yellen is going to be very tough, very hawkish, so to speak, then in a bear market, gold may not do well. However, if you think that asset prices are expensive, if you think that inflation might be ticking up, if you think that the market is not always going to look at the glass as being half full, then when risk premium moving higher, and let me move here to the next chart here, we believe that central banks have taken perceived fear out of the market. Well, if they taking a step back on the monetary policy, if the allowing of yields to back up raises volatility in the markets, then we believe gold can do actually quite well. But of course, we do see a change in the types of people owning gold, holding gold, and that transition in the short term at the least has caused prices to come down. And so what we see is really, we see gold as a diversifier more so than ever, and ideally we would like to encourage people to consider maybe combining a gold position together with a shorting of yields. Now, granted, we don't give specific investment advice, and also that shorting anything can be quite risky, especially if you're short bonds. You have to keep paying the interest, so you've got to have the timing right. When rates are very, very low, the cost isn't so high, but this is not the sort of strategy for everybody, but it's something to look into if that is the sort of thing that you might be considering. And with that, let me go to page 28 here on the slides. Again, we've said central banks have compressed risk premium. That means volatility is lower much of the time. Once in a while it flares up because the markets are, of course, still risky. But the other thing that happens when volatility is so low, things often move more in tandem. Correlation is higher, fragility is higher. And what that basically means is that when fear does flare up, we can zoom into a scared environment. And so that's really the risk in these markets, that prices are expensive, everybody is a little bit on edge, I allege, and bad things can potentially happen. That doesn't mean they will, and obviously we have been told to buy the dips, but it is something that people should be aware of, and so they should be thinking about, well, how can they diversify? Obviously, we showed earlier, you can diversify to different sectors of the economy, but asset prices, even within the different sectors, historically are correlated, and so when prices go down, asset prices, well, how do you diversify? If we move here to the next slide on this cartoon that we've shown a few times now, gold is really I would say, the easiest diversifier. I'm not saying it's always the best diversifier, but it's the easiest because it's understandable. It has a low correlation in the long run, and the challenge with gold, though, is, as you've seen, these correlations are not stable. Now, they're not stable to most things, but it can work against you as well in the short term. If you really want to design a portfolio that's robust enough to stomach a turmoil in both stocks and bonds, because eventually both of them can go down, it is quite possible if we're at the end of the bond bull market, well, you want to have something that otherwise by design is uncorrelated. We, of course, we are active in the currency space, you might have to go to the equity space, the long-short equity strategy. All those strategies have not just unique risks to them, but more importantly, most of them aren't that easy to understand. And that is really one of the reasons why people come back to gold so often, because it's the easiest. But the easiest doesn't mean it's always going to make money. Now, with that, let me here shift gears a little bit and show you this wonderful picture. And the reason I show this picture is that is how investments take place these days. I'm not suggesting that people jump out of an airplane without a parachute. This person has one, it seems. But I grabbed this actually of a website that promotes investment advice, and the message of that site is, and the message in general of many investment professionals is to give investors an investment experience. We live in the age of experiences. Millennials want experiences. And so it used to be that, why should an advisor invest in index ETFs? You're not going to add value in any ways. Well, the way that advisors add value is to structure a portfolio according to an investor's needs. Well, that quote-unquote need is sometimes synonymous with experience. So one structures a portfolio according to one's political beliefs, according to one's social beliefs. Well, I firmly believe that a portfolio should be structured with a goal of profitability. And so when in an era, of course, where stocks are moving up and up and up, well, of course you can express your beliefs, because what can possibly go wrong? Right? Everything goes up anyway. I say that cynically, of course. I don't think things go up all the time. But I'd like to have everybody keep that in mind. Sometimes you've got to jump over your own shadow and see, well, is my portfolio, as much as I love investing in these stocks because they do everything socially right and I happen to believe this and that is going to happen, is that really the most prudent way to invest? And so I'd encourage anybody to really shake their portfolio. Let's move here to the next slide. This is not a product presentation. You can always reach out to us on any of our products if you have questions. I talked plenty about the currency space and the potential value of a long-short currency strategy. The only thing I'd like to add is if you are listening and manage a family office, we do have services these days that we offer to very large investors and family offices. So please feel free to reach out to us. So with that said, let me, before I pass it back to Dan, let me wish everybody here a happy holiday if we are not in touch beforehand. And I hope to see you on our quarterly webinar in January. Now, that said, I've taken some of the closing statement probably away from David here already. David, if you want to manage a brief Q&A, that would be great. David?
Thanks, Axel. Please now take a few minutes to read the following disclosure as we move to the Q&A portion of the call. Again, I would just like to remind everyone that you can ask a question by typing it into your text box. And our first question comes from David Bakken, and he asks, what about the Italian banks? Will nationalization just prolong the collapse, or will Draghi prolong the collapse?
Thank you, David. Yes, Italy is in the news again. They rejected the referendum, and there was hope that a positive outcome would provide the stability to raise money on the equity side. Knowing things in Italy, things are not happening as quickly as they should, and the European Central Bank just might run out of patience. This is ultimately a political question. There are various ways to fix the Italian banking problem. The issue, though, is twofold. One is that there's a problem that, in my view, most European banks have. You don't know what their long-term strategy for profitability is. Draghi just today said that it's not his problem whether banks are profitable or not. He has to worry about price stability. Well, that's a little bit too easy because he does care that they stay in business. And we do know that central banks have the ability to keep even zombie banks afloat. They can provide them with liquidity for an extended period, and they have shown that they're willing to do that. The other issue is politics. Italian banks, in the aftermath of 2008, raised capital by issuing bonds and selling them to retail investors. And so many retail investors hold bonds, including subordinate debt. And one of the agreements in the Eurozone is that if there is a bailout of a bank, there has to be a quote-unquote bail-in, meaning that those who hold subordinate debt at the very least have to take a loss, a so-called haircut. And politically, of course, that's very difficult, that you are now going to penalize the retail investors, which was, by the way, kind of the reason why you want the bail-in of the bondholders is so that the taxpayers don't foot the bill. Well, if you sell the bonds to the retail investors, you kind of get the same thing. And so that's really the challenge here. But of course, the day of reckoning is coming. Really, the question is, what is the fallout of any of that? And the rest of the world doesn't seem to be overly concerned. There have been some weakness in the euro, but we haven't seen really any tension in the so-called safe haven assets. So in many ways, it's foremost an Italian problem. They have to work through this, and so keep your eyes open for that. In many ways, it's a relief to everybody if and when that actually gets taken care of. And then, of course, the real fallout will be in the elections that are subsequent to any bailout. How is the electorate going to penalize the government for giving folks a haircut? Now, that said, these investors have already seen in their statements that the subordinate debt, anyway, has fallen in value quite a bit. Back to you, David.
Okay, thanks, Axel. Our next question comes from Robert Ballou, and he asks, could you discuss the India cash situation and whether a similar situation may happen in the U.S.? Axel?
Thank you for bringing up India. In India, a large portion of the economy is cash-based. And the side effect, of course, of that is that many people don't declare their income, and as a result, the government has no tax revenue. And so the Modi government has a fairly draconian way of dealing with it by just telling folks that your banknotes are no longer good, and you get a very short window to get these to the bank, and there's going to be a hefty penalty if you had not declared where that money was coming from. And as you might imagine, the reaction to that is not a very good one, or not a happy one at least, from the public, and it's given rise for lots of underground networks to find a way to kind of launder that money. Gold has been a beneficiary of that. The price of gold locally in India is substantially above spot, meaning people are paying a premium, are willing to pay a premium in order to convert their cash into gold, and also they spend it in many other ways, and try to find a way to use these banknotes before they're null and void. Ultimately, I think that if a government wants to get a better discipline amongst its citizens to pay taxes, they need to have a transparent tax system that's perceived to be fair, where people are willing to work with the government. So there might be a very significant backlash. The other part of the question is whether this could happen in other countries. Well, the motivation in other countries, in the Western world in particular, is different. The motivation in the Western world is that the government has so much debt. We want interest rates lower, and so if we want to impose negative interest rates, that's much easier if you don't have as much cash in circulation, because you can just debase the value of that digital cash or whatever it might be. And at the same time, as you've seen as well, is the yields are backing up. We might be through the lows of the nominal rates, and so the immediate need isn't there quite as much. Now, that doesn't mean we won't have forces that try to move us in that direction. And as these things happen, of course, people are going to try to hold on to real assets and so forth. So the motivations are different. The timing in the rest of the world, I don't think, may work quite out that well. Sweden, by the way, might be the most advanced one in giving up cash. Now, that said, even without government regulation, of course, we use credit cards more and more. We can just swipe our phone or hold up our phone to do it these days. So it's easier to use electronic cash than it has been in the past. And so, yes, we're moving in that direction. But India is a special case in the sense that you do have a government that's instituting real reform, but this is causing a backlash that the government, I don't know whether it's going to survive at the next election, because a lot of people have, of course, gotten used to not paying the taxes and have been quite happy with it. And usually when you take something away that people are happy with, even if it might be illegal, they might not react favorably at the voting booth. All right, and just a kind of a final word here in the context of gold. When people lose confidence in currency, gold historically is a beneficiary, because it's one of these places, of course, where you can deposit your money. Alrighty, let me pass it back to you, David. Thank you.
Thank you, Axel, and that concludes the Q&A portion of the call. If we were not able to get to your question today, we will get back to you via email. Should you have any additional questions or comments, please use the Contact Us section of the website at www.merkinvestments.com. As always, feel free to reach out to James at any time, and he'll be more than happy to help you with any questions. And this concludes our call. Thank you, and have a great day.